Chapter 23, Cost Variances. Computing and journalizing standard cost variances. I'm gonna do only the computing part. Okay, we're gonna do the calculation for cost variances. I'm not gonna journalize them. Smith manufactures coffee mugs. Okay, so we manufacture coffee mugs. So this is my output. This is my output that it sells to other companies for customizing with their own logos. Smith prepares flexible budgets and uses standard cost system to control manufacturing costs. The standard unit cost of a coffee mug is based on static budget volume of 59,900 coffee mugs. So when he says standard, okay, it means budgeted. So this is the budgeted amount of output because he said mugs. So he gave you for direct materials, he's gonna use 0.2 pounds at 25 cents per pound. So he multiplied them to get 5 cents per mug. Okay, so this is the standard unit cost. For the direct labor, I'm gonna use 3 minutes to make one mug, and the cost will be 11 cents per minute. So if we multiply 3 with 11 cents, I'm gonna get 33 cents per mug. For the manufacturing overhead, you have variable and you have fixed. For the variable, he said you're gonna use 3 minutes, 6 cents per minute. So if we multiply them, we're gonna get 18 cents per mug. For the fixed, 3 minutes at 13 cents per mug. So again, multiply them to get 39 per mug. If you add them up, you're gonna get the manufacturing overhead cost per mug. Again, this is budgeted. This is all standard or budgeted data, okay? Now, actual cost and production information for July 2016. A. Actual production and sales were 62,600 coffee mugs. Again, this is my output. I'm manufacturing mugs. B. Actual direct materials usage was 10,000 pounds at an actual cost 17 cents per pound. Actual direct labor usage of 199,000 minutes at a cost of 27,860. So he gave you the total, not the per minute cost. Actual overhead cost was 8,955 for the variable, 31,945 for the fixed. Selling and administrative costs were 95,000. I'm not gonna use this one. So let's find direct materials variances, direct labor variances, variable overhead variances, and fixed overhead variances. Okay, so now direct materials variances first. I need to multiply actual cost by actual quantity, then standard cost by actual quantity, then standard cost with standard quantity allowed. The difference between the first two, we call it cost variance because the cost was different. The difference between the last two will be called efficiency variance, and the difference between the first and the third, we call it total product cost variance, which is direct materials variance or flexible variance. Now I want to explain something before we start. Now, for the direct materials, what's gonna be your input, what's gonna be your output? Okay, input will be the pounds I'm gonna use to make the mug, while the output is the product that I'm manufacturing, which is coffee mugs. Okay, so For the first column, I need to find actual cost and multiply it with actual quantity, which is input, okay? I need input, not output. For the second one, standard cost multiplied by actual quantity, again, it's input. And standard cost means budgeted cost per input. The last one, it's standard cost, which is budgeted cost multiplied by standard quantity allowed. How can we find standard quantity allowed? I need to multiply actual output by standard input per one output, which means how many pounds do I need to make one mug. Okay, so let's find the answers. Now, for the first one, I need actual input, which is actual amount of pounds, and I need to multiply it with cost per pound. Okay, so the actual data for direct materials was given in B. Actual direct materials usage was 10,000 pounds at an actual cost 17 cents per pound. So I need to multiply 10,000 pounds with 17 cents per pound. And the amount is 1,700. Now, for the second one, standard cost multiplied by actual input. Again, actual input is the same one, 10,000 pounds. Now I need to multiply it with standard cost. Okay, so standard cost means budgeted cost for direct materials. I need 25 cents per pound or 5 cents per mug. Since I'm using pounds, so I need to multiply it with cost per pound. So I'm gonna use the 25 cents per pound. Okay, and as we said at the beginning of this question, we said the data given here is standard, so this is budgeted, and here is the actual data. So now 10,000 pounds multiplied with 25 cents per pound, so it's gonna be 2,500. Now the last one, I need to find standard quantity allowed, in which I need to multiply actual output or mugs by standard input per one output. So actual output is 62,600 mugs, 62,600 coffee mugs. I need to multiply this amount with standard input per one output. How many pounds do I need to make one mug, which is 0.2 pounds. Okay, so if we multiply 62,600 with 0.2, I'm gonna get 12,520 pounds. Now this is the standard quantity allowed. Okay, I need to multiply this answer with standard cost, which is 25 cents per pound. Again, I have pounds, not mugs, so I should not use the 5 cents per mug. I need the 25 cents per pound. Okay, so the answer will be 3,130. Now, the difference between 1,700 and 2,500 will be 800. And the difference between 3,130 and 2,500 is going to be 630. Now let's see, is it favorable or unfavorable variance? Direct materials is a cost. So I expected to pay 2,500, I paid 1,700, I paid less, so it's gonna be favorable variance. Here, I expected to pay 3,130, I paid 2,500, so it's gonna be favorable. Now to find total product cost variance, which is direct materials variance, I'm gonna find the difference between the first and the last. So the difference between 1,700 and 3,130, it's gonna be 1,430. Now, is it favorable or unfavorable? I expected to pay 3,130, I paid only 1,700, I paid less, so it's gonna be favorable. So as you can see, if both of them are favorable variances, the total product cost variance will be the total. I'm gonna add them up. If both are favorable, we add them up. If both unfavorable, we add them up. If one is favorable, one is unfavorable, we subtract, and favorable or unfavorable will be based on the greater number. Direct labor variances. Okay, I'm gonna use the same chart to find the variances like the one we used for direct materials. But now here, I'm gonna decide the input and the output. The input for the direct labor, as mentioned here, is minutes. Okay, sometimes it can be hours, but in this question it's minutes. And the output will be the product that I'm manufacturing, which is coffee mugs. Okay, so I need to multiply actual cost with actual quantity, which is actual input. For the second one, standard cost or budgeted cost by actual input. The last one, standard cost or budgeted cost multiplied by standard quantity allowed. And to find standard quantity allowed, I need to multiply actual output or mugs by standard input per one output. Okay. Now, actual cost multiplied by actual input for the direct labor. So I need to look at C. The actual input is 199,000 minutes. I need to multiply it with actual cost per minute. But here he gave you the total amount, 27,860. So if you multiply the number of minutes with X, you're gonna get 27,860. We don't need to find X, but if you want to find X, you need to divide 27,860 by the number of minutes, which is 199,000. And you're gonna get the actual cost per minute. Okay, I don't need it here, but I can find it for you. It's gonna be 14 cents per minute. Okay, now the second one, standard cost by actual input. Again, actual input for the direct labor, it's gonna be 199,000 minutes multiplied by the standard cost per minute. Let's look at the standard here for the direct labor. I need 3 minutes and each minute will cost me 11 cents. The 33 cents, it's per mug. I don't care about per mug. I care about the minutes because here I have minutes. So I need to multiply it with 11 cents. So 199,000 times 11 cents, it's gonna be 21,890. Now last one, actual output multiplied by standard input per one output. actual output is actual number of mugs, which is 62,600 mugs. I need to multiply it with standard number of minutes to make one mug. Okay, so I need 3 minutes to make one mug. So I need to multiply it with 3 minutes to get the total amount of minutes. So 6,600 times 3, it's gonna be 187,800 minutes. Now this one is called standard quantity allowed. I need to multiply it with standard cost per minute, which is 11 cents. So if we multiply these two, I'm gonna get 20,658. Now the difference between 27,860 with 21,890 will be 5,970. The difference between 21,890 and 20,658 is gonna be 1,232. Direct labor is a cost. So I expected to pay 21,890, I paid 27,860, so I paid more, so it's gonna be unfavorable. Here I expected to pay 20, I paid 21, I paid more, so it's gonna be unfavorable variance. Now the difference between 27,860 and 2,658 will be direct labor variance, which is 7,202. Now is it favorable or unfavorable? I expected to pay 20, I paid 27, I paid more, so it's gonna be unfavorable. As we said before, if both of these variances are favorable, we add. Unfavorable, we add. One favorable, one unfavorable, we subtract. So for this case, both are unfavorable, so I'm gonna get the total and it will also be unfavorable. Variable overhead. So I'm gonna use the same chart that I use for direct materials and direct labor. Again, you need to check what's the input, what's the output. For variable overhead, as you can see here, it's minutes. Okay, so the input will be similar to the direct labor. It's gonna be minutes. Okay, and for the output, again, I'm making mugs. So this is my output. So the first one, actual cost multiplied by actual input. The second one, standard cost or budgeted cost by actual input. Last one, standard cost or budgeted cost by standard quantity allowed. And we can find this answer by multiplying actual output with standard input per one output. Okay, so now let's find actual input and actual cost. So I'm gonna look at D. Actual overhead cost was 8,955 for the variable. So I care about the variable now. So he gave you the number already calculated, no need to find it. 8,955, no need to multiply anything. The second one, standard cost by actual input. Again, actual input is actual amount of minutes. Okay, multiplied by standard cost per minute. So actual quantity or input will be similar to the direct labor, which is 199,000 minutes. Okay, I need to multiply it with standard cost or budgeted cost, but for the variable overhead. So what's going to be the standard cost per minute? It's going to be 6 cents. Okay, and again, I'm not gonna use the 18 because this is per mug. I have minutes, not mugs. So I need to multiply it with 6 cents. So 199,000 times 6 cents, it's gonna be 11,940. Last one, to find the standard quantity allowed, I need to multiply actual output, which is actual number of mugs, which is 62,600, multiplied by standard input per one output. So how many minutes do I need to make one mug? He said 3, so I need to multiply it with 3. So 62,600 times 3, it's gonna be 187,800 minutes. Now you need to multiply the standard quantity allowed by standard cost. What's the standard cost per minute? It's gonna be what? 6 cents. So it's gonna be 11,268. Now the difference between 8,955 with 11,940 is 2,985. And the difference between 11,940 and 11,268 is 672. Now I expected to pay 11, I paid 8. So it's going to be favorable variance. I paid less. I expected to pay 11,268. I paid 11,940. I paid more. So it's going to be unfavorable variance. Now to find the variable overhead variance, I need to find the difference between 8,955 and 11,268. It's going to be 2,313. Now, is it favorable or unfavorable? I expected to pay 11, I paid 8, I paid less, so it's going to be favorable. So now, as you can see, one of them is favorable, one of them is unfavorable. So I need to find the difference between them, and it's going to be according to the greater number, so it's going to be favorable. So if you subtract these two, you're going to get this answer. Now, last cost variance for this video will be fixed overhead variances. Now the first one will be actual fixed overhead, the second will be budgeted fixed overhead, the last one will be allocated fixed overhead. Okay, so for the actual fixed overhead, I'm gonna look here at D. The actual for the fixed, it's gonna be 31,945. Budgeted fixed overhead, again, fixed is constant as total. So I need budgeted fixed overhead. So I need to multiply budgeted input with budgeted cost. Okay, so let's look here for the fixed. He said it's gonna be 3 minutes per mug, 13 cents per minute, or 39 cents per mug. Okay, I need the budgeted amount of minutes. Do I have it here? I don't have it, but I can get it. So I have 59,900 coffee mugs. This is the budgeted amount of output. So if you multiply 59,900 mugs with standard input per one output, which is 3 minutes, I need 3 minutes to make each mug. I'm gonna get the budgeted amount of minutes, which is budgeted input, which is 179,700 minutes. And this one will be multiplied with the 13 cents per minute. Okay, so this is the budgeted fixed overhead, all budgeted. It's gonna be 23,361. Now allocated fixed overhead, I need to multiply standard quantity allowed by standard cost. So to find standard quantity allowed, I need to find actual output and multiply it with standard input per one output. So 62,600 mugs multiplied by standard input per one output, which is 3. So I'm gonna get 187,800 minutes. Then I need to multiply it with standard cost per minute, which is 13 cents. So the answer will be 24,414. Now the difference between 31,945 and 23,361 is 8,584. And the difference between 23,361 and 24,414, it's gonna be 1,053. Now, is it favorable or unfavorable variances? For the first one, I expected to pay 23, I paid 31, I paid more, so it's gonna be unfavorable. For the second one, I expected to pay 24, I paid 23, I paid less, so it's gonna be favorable variance. Now the difference between the first and the last, 31,945 less 24,414, it's gonna be 7,531. Is it favorable or unfavorable? It should be unfavorable, okay, because I expected to pay 24, I paid 31, so it's gonna be unfavorable. And again, I told you before, if one of them is favorable and the second one is unfavorable, you need to subtract, and you're gonna decide if it's favorable or unfavorable based on the greater amount between these two. So this is the greater one, so it should be unfavorable. Thank you for watching. If you have any question, please leave a comment. Please like, share and subscribe.